Welcome to vTalkInsight, Risk Sentiment Daily for January 29, 2026. Today the market is caught between an AI and growth boom on one side and rising currency and geopolitical stress on the other. Let us unpack what that balance looks like across assets and what is driving risk appetite right now. Risk sentiment today is cautiously risk-on, with equities hovering near record territory even as macro and political headlines grow louder. The S&P 500 has effectively stalled after several days of gains, and volatility remains anchored in the mid-teens, suggesting investors are still willing to hold risk, but are adding protection at the margin. Underpinning this resilience is a powerful combination of strong U.S. growth, aggressive fiscal support, and an AI-driven capex wave that is feeding through to earnings, especially in semiconductors and cloud infrastructure. Global equity markets show broad strength, with nearly all U.S. sectors positive year-to-date and every tracked country trading above its short-term trend, pointing to a synchronized, if mature, bull phase. At the same time, investors are increasingly aware of rising macro and geopolitical risks. A rapidly weakening U.S. dollar, sharp moves in major currency pairs, record gold prices, and renewed tension in the Middle East all signal that portfolios are being hedged more actively, even as core risk positions remain in place. AI-driven growth and tech earnings remain the single most important bullish driver for markets. The U.S. growth outlook is exceptionally strong, with nowcast estimates above 5%, and a large share of that expansion is being attributed to productivity gains and heavy capital expenditure from a handful of dominant tech firms. Semiconductors are at the center of this story. ESML has reported record quarterly bookings and expects sales to keep growing through 2026, while customers accelerate capacity expansion on the belief that AI-related demand is durable at least over the medium term. Strong numbers and upbeat outlooks from ASML, Texas Instruments, Seagate, and other data center and infrastructure names reinforce the message that the AI hardware cycle is still in full swing. This enthusiasm is reflected in market structure. The top group of tech-related stocks now represents around 40% of U.S. large-cap market capitalization, making the broader equity tape heavily dependent on a narrow set of AI winners. While the sector's valuation premium has narrowed compared with last year, expectations for companies like Microsoft and its Azure cloud franchise remain demanding, and even modest disappointments for firms such as Meta could trigger outsized moves. Beyond the AI theme, robust growth and fiscal tailwinds are reinforcing the risk-on backdrop. U.S. GDP is tracking well above recent norms, helped by strong domestic demand, AI-linked investment, and a fiscal stance that remains distinctly expansionary. Fiscal expansion is expected to contribute meaningfully to growth this year, with some estimates suggesting that roughly half of incremental GDP could be driven by government spending. Anticipated tax refunds of well over $100 billion are set to deliver a front-loaded boost to household cash flows, supporting consumption through the first half of the year even as parts of the labor market show early signs of strain. Equity leadership reflects this macro mix. Cyclical sectors and small caps have outperformed year-to-date, alongside resource-heavy areas such as energy and materials which are benefiting from global demand and a softer dollar. The risk, flagged by several investors, is that these tailwinds may fade later in the year if consumer confidence remains depressed or fiscal space narrows, which is why the current phase is seen as an opportunity-rich but time-limited window rather than a new cycle entirely. Supportive financial conditions and capital flows provide an additional cushion for risk assets. Credit spreads are tight, corporate profits are near record highs, and a softer dollar is easing conditions for borrowers outside the United States, all of which helps explain why equities are holding up despite frequent macro shocks. Demand for U.S. fixed income remains notably strong. Foreign holdings of treasuries and corporate bonds are at record levels, and recent auctions, including at the very long end in Japan, have gone smoothly, helping to stabilize global bond markets even when individual sovereign curves, such as Japanese government bonds, experience bouts of volatility. Central bank actions also matter here. The Federal Reserve is still injecting significant liquidity into the system each month, contributing to suppressed yields relative to where pure fundamentals might otherwise push them, while investors increasingly see value in longer duration as higher-term premia improve carry. The counterpoint is that if inflation expectations or fiscal concerns re-accelerate, or if issuance patterns shift, term premia could rise again and challenge this benign backdrop. On the bearish side, accelerating dollar weakness and FX volatility are emerging as key macro risks. The U.S. currency has slipped to multi-year lows, with policymakers appearing more comfortable with a softer dollar in order to support exports and domestic manufacturing, and recent remarks from the administration have reinforced that perception. Markets are taking these signals seriously. Options markets show rising costs to position against the dollar, while major currency pairs such as the euro and the yen have seen sharp moves. At the same time, other central banks are pushing back against rapid appreciation in their own currencies, raising the specter of competitive devaluations and a potential currency war, which would amplify FX volatility and complicate cross-border capital flows. The macro implications are significant. A weaker dollar can lift U.S. import prices, adding to existing inflation pressures from tariffs and sticky services costs, and in turn push intermediate and long-term yields higher as investors demand compensation for that risk. So far, these moves have not triggered disorderly capital flight, and foreign appetite for U.S. assets remains robust, but the pace of depreciation is increasingly seen as a key variable for cross-asset volatility. Rising geopolitical risk and gold stress form the second major bearish cluster. Tensions between the United States and Iran have escalated, with a large naval presence and clear ultimatums raising the probability of targeted strikes, while disputes with NATO allies and persistent trade frictions with China are adding to the overall risk premium. Gold has become a central expression of these fears. Prices have pushed to new highs, supported by sovereign and institutional buying as countries diversify reserves away from the dollar and investors seek hedges against both market volatility and geopolitical shocks. Even outside traditional finance, large crypto players have accumulated substantial physical holdings and continue to add, contributing to a powerful demand impulse in a relatively small market. This hedge, however, is becoming crowded. Gold now trades well above its long-run trend, with some forecasts pointing to levels that would historically be associated with acute market stress. Inflows from new institutional participants have increased day-to-day volatility, and any positive surprise on geopolitics or policy could trigger sharp pullbacks, making gold both a barometer of risk and a potential source of instability in its own right. The third bearish driver is a cluster of late-cycle equity, inflation, and rate risks. Equity gains to new highs are being driven by a relatively narrow group of large-cap names, with market breadth deteriorating and volatility ticking higher ahead of major earnings releases and central bank decisions, all against a backdrop of still elevated valuations. Inflation dynamics add to this fragility. Core measures such as PCE have made little net progress toward target in recent months, with sticky services prices, tariff-related goods inflation, and persistent wage growth all complicating the final leg of disinflation. This has helped push up term premia, particularly at the long end of the U.S. curve, where yields around the 30-year sector have approached levels that begin to pressure housing and other interest-sensitive sectors. Beneath the strong GDP figures, the real economy looks more uneven. Consumer confidence has dropped to decade lows, affordability remains a top concern, and recent job cuts at large employers like Amazon and UPS point to a softer labor backdrop than headline data alone suggest. With a Fed chair nomination politicized and the timing of rate cuts uncertain, markets are left balancing a powerful growth and AI narrative against mounting evidence that the cycle is maturing, leaving less room for error if earnings, inflation, or policy surprise in the wrong direction. Putting it all together, today's tape reflects a cautiously risk-on stance. AI-driven growth, robust macro and fiscal support, and still easy financial conditions keep investors engaged, while accelerating dollar weakness, heightened geopolitical risk, and late-cycle pressures around valuations, inflation, and yields are driving a meaningful bid for hedges. Markets will be watching upcoming tech earnings, central bank communication, FX moves, and gold price action for clues on whether the growth narrative can keep dominating or whether the balance tips toward a more defensive regime. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.